All right, welcome back to another episode of More Than a Mortgage, where we help you build wealth through smart financial decisions in real estate. I am your host, Mike Black, and this is
Tom Merritt.
all right. And you're probably wondering what's going on with the nerdy smart look today, right?
Yeah, I mean, it's almost like you just found those glasses sitting on the desk and said, hey, let's try it out.
Yeah, well, hey, sometimes you gotta look a little smarter than you actually are. So
Whatever works.
Appreciate you guys joining us today. We actually have a great episode. It's one that we get a lot of questions on. I think I know I get more questions than I can count on a stick with this thing, but
Yeah, I'm super excited about it actually because it's one of those things that I don't think people realize is a topic, but then when we get into the process, whether it's purchasing a home or refinancing, that no matter what, every single time the topic comes up and the question is, should I or shouldn't I?
yeah. So one of the things we're going to talk about today is, should I pay down my mortgage faster or should I invest my money in other places? And so for those of you out there that have wondered, does this pertain to you? We did an episode last week with refinancing and does it make sense to refinance? And so one of the things that we go through when we talk about your mortgage is, when do you pay it down? When's the right time to start actually paying it off? I guess there's not a right or wrong answer with it, but
Well, that was my question. What's the answer? We've been waiting.
there's really not. So for those of you that may not own a home today or maybe thinking about this, that there's different options out there, and part of what we love about our jobs is that we're kind of an a la carte, customized mortgage lender where we help you come up with solutions that fit your needs. And so, I'll take the glasses off so everybody can see my face, but one of the things that people ask all the time is, hey Mike, should I do a 15-year? Should I do a 20-year? Should I do a 30-year? When do I start paying this down? Because some people just don't like debt.
Absolutely. I think it's almost similarly, should I put 20% down or maybe even 30 or 40% down when I purchase a property, or should I put less down? And those are kind of the questions that we deal with every single client that we sit down with. And I feel like this is a running theme with every episode. It's all about the person, and it's all about having that conversation, sitting down and figuring out what are your goals, where are you at in life, both from a financial perspective and where your goals are and where you want to be. Because really, at the end of the day, that is where the answer is held.
Yeah.
So, I don't know, what are your thoughts?
So I've always kind of lived by, I'm a big investor in the markets. I like having my money working for me. So I've been more of a leverage type of guy. Where, a lot of my mentors taught me at a younger age that you should really focus on paying that mortgage down when you get to be about 50. And so from 50 on, that's probably where I'll set, if I have a mortgage in place, I'll probably set up a 15-year fix to kind of finish me out through retirement and be done with housing payments, period. But it just depends. It's been a lot of meetings with my financial advisor. It's what fits me the best. And for me, I've always been a lower down payment type of guy. I like to put 5 to 10% down, especially on my first 2 or 3 homes I've ever bought. And I like to take that money that I would have put to get to 20 or 25% down and put that in, I'm an S&P 500 guy,
Yeah,
QQQ. I love playing the markets. And I've got 5 or 6 stocks that I just like to play all the time that I use in my life. So for me, looking at it now, right now I think my account's up almost 40% in the markets.
Wow.
Whereas,
Nice.
I would have been saving maybe a little bit in interest on my house, but, again, it just depends on what your situation looks like, right?
Absolutely, because I could, talk about a client that has, multiple credit cards with lots of debt on it, perhaps student loans or some other type of debt. Again, at the end of the day, if you're going to have debt, probably your best debt vehicle is going to be the mortgage. Many reasons why. One, because it's long-term and it's fixed. It's not going to change on you. And number 2, the asset that it's securing, the home, regardless of how much you put down initially and or pay down, that's not going to influence the appreciation or the value of it. And so it is going to be what it's going to be. So if you have a lot of debt, I would suggest putting less down or maybe not being as aggressive with regards to paying it off, because you can utilize that additional cash flow to pay down your other debt.
Agreed.
And reduce the overhead.
So if I hear you, what you're saying, it all comes down also to what your interest that you're paying looks like too.
Absolutely.
That's a big piece. I mean, I know it's been harder, like all through the post-pandemic when rates jumped up into the 7s and 8s. Like I found that nobody was really doing a 15-year or a 20-year fix because it just didn't make sense because of the amount of interest they were paying relative to what they could have gotten in the markets.
Yeah, and the cash flow on a monthly basis. Payments doubled, if you will, from the pandemic time of 3% to the 7-8%. So just even on a monthly basis with a 30-year fixed mortgage, you're able to spread that payment out and help with the cash flow. When we get down to 2.5% interest rates, okay, now it's probably a little more manageable with regards to, again, just the day-to-day.
2.5. That means you don't have a job. That means the world's coming down and crashing. So. But I think, a good number to focus on is when you get into like the 5s or the 6s.
Yeah.
Like one of the things that I love about the refinance world right now is that, you could go to an order taker that just says, hey, you tell them I want to refinance. And they say, okay, great. We're going to just put you into a 30-year fix. But if you really break down the schematics behind it, like a 30-year right now at 7.5%, and you can get it down to a 20-year for like a 5.5% and keep the same payment, that can make sense, right?
Absolutely.
And so the other mindset to that is like, okay, do I do a 30-year fix at 7.5% and I get down to like 6.375 and I save that $300 a month? The key is what are you doing with that? So are you reinvesting that in the markets? Are you paying that down towards principal?
Going to Vegas and putting it on black.
Yeah, there you go. Always bet on black. That's what I tell everybody. But that's how you should build wealth in real estate, right? You don't just go back to living your life normal and, not look at the leverage side of pay down faster or invest.
I also want to make the point too, and you made mention earlier, when you get to 50 is when you're going to focus on paying that down. And I think age plays a huge role in this. Something called compounding interest. And that's from an investment perspective. If you're 20 years old and put $50 a month in some type of a return or investment vehicle, versus if you're 60 and put that same $50, by the time you're 70, you have a lot less if you started at 60 than you do if you started at 20. And not just because of the money or amount of money you put in there, but because of the compounding interest and making interest upon interest and so on and so forth. Yeah. So again, these decisions that we're talking about, again, you mentioned 50 years old, versus if you're 20 or 25, you should have a completely different mindset with regards to where you're trying to be and where you're trying to go. And I think part of this podcast and the reason we did it is really helping people understand that, maybe paying off the mortgage right away isn't your best option. I've always kind of had the mentality that at the end of the day, I want the ability to retire. Have enough money in the bank so if I choose to stop working, I can. And one of those best ways to do that is through different types of investments. Everyone's talking about diversified portfolios. So being able to, early on in life, be able to put some money in stocks, put some money in the homes, put that 5% or whatever it may be. All of these at the end of the day, by the time you hit 50, should hopefully have gotten to the point where you can start paying that mortgage off and not sacrificing.
And so I want to give you like a real life example, and I'm just going to use me as an example. And again, I don't know like where the markets go in the next 3 to 5 years, but I bought my first home with 5% down. Mm-hmm. It was the worst time ever to buy real estate in 2006, new construction. But from that point forward, every house that I bought, I just did 10% down. Okay, and that's because I had the extra cash to do it, and I had a budget that I was trying to achieve through the purchase, right? So I did 10% down on the next couple properties that I bought. The last house that I bought, I did 20% down because the loan required it.
Yep.
Okay. So I'm on my fourth or fifth purchase of a property since 2006, and there is a really good chance that when I sell this home, we'll probably downsize because we'll have 2 boys in college, and I'll be almost 50, and everybody knows my age, and I may not have a mortgage just from appreciation for the most part alone, right? And that's because real estate has gone up here in Chicago quite a bit. I've let the appreciation do all the work for me, but I've run it simultaneous with my investments. And so my investments are up 40%. my home value has gone up probably over the last 10, 15 years, 200+%. And so that's kind of the game that I've played. And,
I love it.
And again, it doesn't work out like that perfectly for everybody, but the whole mindset when you get with a first-time home buyer and say, hey, 5% down is an okay setup for you on your first home purchase, because in 5 years, which is what most first-time home buyers are in their homes for, that's going to roll over to a 10% on the next home. And then, you're probably not going to buy your forever home the next time around. Family's going to grow, and then that's going to hit that 20%. And then you're playing on house money in essence, right?
Absolutely. And that's exactly what it is. And again, it's almost reinvesting the money you have and helping you to build and create the wealth that, again, you get to that point, or you get to where you want to be. And again, you kind of earmarked 50, and it could be 45, it could be 55, but you're in that position to get you to the point where you can retire.
Right. And the goal is when you retire, you have as little debt as possible, right? That's really the goal that I have set up for my family, is that I want to be debt free for the most part, because at that point I want to live my life in retirement the way I want to live my life, and I don't want to have this burden of credit cards and housing payments and everything else floating over top of my head. So again, it takes time to sit down and structure this stuff out. I think a great symbiotic relationship for us is we work well with financial advisors.
Absolutely.
To make sure that we're doing what they have planned out for their clients as well. And some of the best clients that I have, I can tell you that I've had conversations with their financial advisor to make sure that I'm doing the right thing that they want, because it really starts there. I mean, that planning phase with your financial advisor and what your advisor is telling you to do and showing you that path to financial freedom and retirement is huge on our side, because then we can kind of cater towards what they want.
And I think that's an important part to make, is that everybody's situation is different. And even just personal belief or feeling, I have a client similar age as us who we've just in the process right now of refinancing, and we're going from a 30 to a 20 because of the feeling, because of the stress, and just the ability that this, my client wants to be done with their housing payments by the time they're a certain age. And so for them, this is kind of a forced mechanism to do it. It's going to keep the payment pretty close to the same because of the reduction of interest rate, but for him, it's just a personal thing. I'm with you. I'm waiting till I'm 50 to really focus on doing it. But again, everybody's personal situations are going to be different, and that's why it's super important, as you mentioned, to have that meeting, to have that consultative approach where we're learning what the goals are, we're learning what stresses them out, and ideally working with those financial advisors to make the reality happen.
Yeah, and it pains me to see sometimes people put down 50% or when it's really unnecessary. Right?
Agreed.
And so, that's kind of where, what Tom mentioned, sitting down and having that conversation is important, because if we could show you like what your return on your investment looks like with less down, it's actually greater. When you go back to that story I just told you, like the homes I purchased over the years, where I'm at today, where I started, I didn't have a pot to piss in, but now I'm telling you that next home that I buy, when we downsize, I'll probably roll that either in to pay cash for it, or take a small mortgage out and invest a good portion of it as well.
Absolutely. And part of that will probably depend on where the market is, where the market's going, and how you want to leverage.
Yeah.
And again, it's all going to be point in time when you make that decision. But again, having the ability, I think, is the key.
Yeah. Now, on the flip side, I'll tell you, like, I see the other side of the fence. Like, if you looked at an amortization schedule on a 30-year, it's been painstaking. It's been one of those like, oh my gosh, I'm not paying down any principal on my mortgage at these 7% rates that we've been in for the longest time. So I get the long-term plan where you have like a 15-year and you're comparing that to a 30-year and maybe it bumps your payments up a little bit. I understand, paying that down because you are building wealth through real estate by doing that.
Sure.
But you got to ask yourself the question, if you're getting a 20-year versus a 15 and it's saving you an extra $300-400 a month towards principal, what are you doing with that? Like, where are you putting that money, that additional money that you would have been saving? Because there is a real cost benefit to having a lower interest rate and what you can do in the markets, especially in the markets that we're in right now.
I agree. I think the other side that people aren't necessarily looking at, though, especially with a mortgage, is when you're typically in your 40s and even 50s, that is usually your highest income earning years. And so even having a mortgage helps from an income tax perspective, because you've got those tax deductions that you otherwise wouldn't have if you had paid off your mortgage. Now, whether or not you're at that threshold versus the standard deduction, and everyone's situations being different, obviously it's again individualized, but having that vehicle during your high income earning years can be very beneficial, again, as a wealth building investing.
That's one of the main reasons I have a mortgage, because I like to have that write-off at the end of the year. I like to have those deductions, and as your income does go up, it's important to have. I mean, we're always looking for ways to get deductions in our lives these days. So,
yeah.
Good stuff. Well, look, I think to sum things up on what we've talked about today, doing a shorter term, paying your mortgage down faster, it might give you peace of mind, but it might not be the best move for you. So if you are struggling with finding good financial advisors, I highly recommend sitting down with a good one that is going to meet you a few times a year and run through your portfolio. We've got some really good recommendations for that. On top of that, sitting down with your CPA. If you don't have a good CPA, that's important, because they're going to coach you around deductions that you do need, and maybe they'll tell you it's not worth paying off the mortgage right now. So, really think through it all. Some people think it's just as easy. I know I've said this before, and I laugh every time I say it, but it's not just push button, shoot rocket, get mortgage.
Yeah.
There's a lot more that goes into this process if you want to do it the right way and build wealth the right way. So any final thoughts that you want to talk about, Tom?
I think you summed it up really well. I think the reality is that it always comes down to you as the individual, where your goals are and where you are in life, and really making your mortgage work for you in conjunction with your financial goals and your financial advisors and your CPA, and bringing everybody together as a team to help you achieve the goals that you want to achieve at the time you want to achieve them.
For sure. Well, if any of you have questions around this, we've got some great tools that we can sit down and show you what this means to you. In fact, I'm doing a lot of 15-minute sessions with my past clients right now, just making sure we're putting them in the right spot, making sure it's the right move for them, and it doesn't cost you anything. It's free. It's free advice. So Tom and I love to give free advice out there. Please follow us. We're on social media. We're on YouTube. If you have questions or you have topics that you want us to cover on the show, we'd love to cover those.
Put it down in the comments below. We'll jump on it.
That's why it's more than a mortgage. It doesn't have to always be about mortgage either. There's a lot of things that Tom and I like to talk about outside of this business as well. But thanks for joining us today, everyone. And
I'm Tom Merritt.
And I'm Mike Black. And we are
More Than a Mortgage.